Over the past week, we've gotten a lot of data on employments and the labor force. And this data is really important because this is what the Federal Reserve uses to determine how they'll move with monetary policy moving forward. And I saw some things in some of these reports that I thought were really interesting and that are really important to highlight, that we are starting to see a massive shift in the labor market. So let's talk about these free reports that just came out and go into some detail. So let's get right into it. So let's start off on Tuesday, where we got the JOLTS report, which stands for Jobs Opening and Labor Turnover. And on that report, job openings fell about 350K down to 8.8 million jobs. And we saw job openings decrease in professional and business services, healthcare, and government. And we saw an increase in tech, transportation, warehouse, and utilities. And this is pretty much along the lines of what we have been seeing recently. What I thought was really interesting from that report was what we heard about quits. Quits actually decreased for the month by 250,000 jobs. And most of these openings were in travel, food, wholesale trade, so think like retail, and entertainment and recreational. This really kind of reiterates what we have been seeing with a lot of the consumer data, because we have seen that the consumer, not only in the US, but this internationally, is starting to weaken. And these sectors really fueled inflation over the past couple of years. So it is interesting to see that we are starting to see less quits. I think there's starting to become some, I guess you could say, job insecurity in those fields. And this aligns with earnings reports we read from companies as well. You know, I just got done reading the Etsy earnings report, and man, let me tell you, if you want to see a weakening consumer, just look at that Etsy's report. So moving on to the ADP private payroll report that we got on Wednesday. So the ADP private payroll mostly covers the data that ADP has on different private sector jobs. So from their data, they found that the private sector gained about 177 jobs in the month of August, which was a significant slowdown from the 312,000 job number that we got in July. I think that's like almost half of the reading, so pretty significant slowdown there. So in the report, they stated that, quote, this month's numbers are consistent with the pace of job creations before the pandemic, unquote. And they also quoted saying, quote, we are moving towards a more sustainable growth in pay and employment as the economic effects of the pandemic recede, unquote. Those are two really big statements. And the reason why is because before the pandemic, there was no concern of a wage price spiral. And to be honest, that is the Fed's main concern, is that their concerns obviously about inflation, but what causes inflation? A wage price spiral. Well, if we're getting news now from economists saying that these numbers that we're starting to get are more consistent in line with what the job growth was before the pandemic, then that almost is like a big old white flag to the Fed saying, hey, y'all did your job. You're done. Y'all did great. Okay, now don't send us to a recession. That's pretty much what I got from that statement there. But looking at the data in the report, when we look at the jobs data, leisure and hospitality only grew by 30,000 jobs in the month of August, which, you know, is still a good amount of job growth, but it's like almost nothing compared to what we saw at the beginning of the year, where leisure and hospitality was growing like 250,000 jobs a month. So significant slowdown between the beginning of the year and now. So when we look at the jobs data from an establishment side point of view, we see that small businesses added about 20,000 jobs, whereas medium and large businesses added about 80,000 jobs. This discrepancy, I think, is caused by some of the financial issues we're starting to see with some of the smaller companies. You know, there was a piece in the Wall Street Journal that I read, and it talked about how a lot of smaller companies are being issued loans at very high interest rates. But some of the larger companies out there that are more established, that have more free cash flow, are actually getting loans at much more competitive rates. And I think this is some of the reason why we've seen the Russell 3000, which tracks small caps. I think that's why we're still seeing it down like 25-30%. Whereas we see all the other indexes down maybe in the single digits from all-time highs. So I think that this is that you're starting to see some more of these larger companies start to actually reinvest into their business in this time, where a lot of the smaller businesses have to kind of just hang on financially, and they don't really have the option of going to debt markets to be able to fund their operations the way they did during the past COVID and that decade before COVID, where we had really low interest rates. When it comes to pay data, we saw that job stayers year over year pay increased about 5.9%, which is the slowest rate we've seen since August of 2021. And it's the first time we saw a slowdown in pay growth in all 50 states in the nation. During one of Jerome Powell's speeches, I believe it was at the Brookings Institute, he did talk about what rate he would like to see wages increase that are consistent with 2% inflation. And basically what he said, just in summary, or at least what I took away from it, was that he basically said that he'd want to see about 1% or 2% above their 2% target. So that would put us maybe inside a neighborhood of like 4 or 5%. It's still on the high side, but it's still a lot lower than what we're seeing at the beginning of the year, where we're like at 12%. We saw above average pay growth in construction, finance, and leisure and hospitality. Now, like I said before, leisure and hospitality employment is still growing, but it's just not growing at the rate that it was in the past. So it does make sense that it still would be on this list of above average growth. There's still some maybe lag effects coming through the data, but we also did see it in financials. The market is starting to pick up, and generally when the market starts to pick up, that's when people are actually interested in sitting down with a financial advisor, or maybe start to invest their money with a financial advisor. So that's probably why we saw the uptick in financials. And in construction, in my opinion, it really has to do with the surge of new home construction that's going on due to tight inventory in the real estate market. So when we split up the pay increases by firm size, we see that smaller firms gave an average pay raise of about 5%, whereas medium and large firms gave a pay raise of about 6%, which again, going back to what I talked about earlier about being able to raise money, this does make sense that it seems like a lot of small firms are under pressure, just given the fact that we are in such a high interest rate environment and money isn't as cheap as it used to be. Then on Friday, we got the kind of granddaddy of them all for the month of August, which was the BLS jobs report, or they call it the employment situation. It's the same thing. To the market, this is considered to be like the official jobs report. And the other two are kind of just like precursors to like what we may see on this report. We did see that non-farm payrolls did increase about 200,000 positions, and that the unemployment rate rose from 3.5% to 3.8%. The unemployment rate moving up as much as it did was very shocking to a lot of people in the market, and it actually caused the market to somewhat do well early on when the report came out in the morning. Obviously, the market sold off a bit throughout the day and kind of ended flat, but still, this was a very good report overall, just on the headline numbers. And then when we look into the report, we see that the labor force participation rose for the first time since March, which signaling that households are starting to feel the pressure of having to maybe make up income and start to head back to work. So that was something that was maybe not so great on the front of the everyday consumer, but was good for the Federal Reserve and what they want, which is inflation to slow down. The sectors where we saw gains in positions were healthcare, social assistance, construction, and leisure and hospitality, kind of in line with the other two reports that we got. And with leisure and hospitality, it was really interesting because in this report, they only gained 40,000 jobs, whereas for the over the past 12 months, the average has been 61,000 jobs. So like I said, we're seeing significant slowdown in leisure and hospitality. If you look at any airlines earnings or any hotel earnings, you'll see very quickly that they definitely do see a slowdown in their business coming very soon, especially on the domestic front. So when it comes to average hourly earnings, it rose about 0.2% for the month, or 2.4% if you were to annualize that number. For the last 12 months, it came out to 4.3%. So again, it's kind of in that ballpark that Jerome Powell did say that the Fed is looking for, to see wage gains to be consistent with 2% inflation. So overall, I think all three of these reports are like a really big sign that there's a very good chance the Federal Reserve will not hike in their next meeting, I believe later this month. And I think that a good chunk of the market already sees this coming, but I hope that the Federal Reserve does, because if they continue to keep hiking in this environment, they have a really good chance that they might push us into a recession. That's all I got for you guys in this video. Thank you so much for watching. As always, please like, share, and subscribe, and I'll see you in the next video. Peace.